We're proud to welcome you to the Exceptional Advisor podcast series brought to you by the Investments in Wealth Institute. The goal of this series is to help you better serve your clients, differentiate yourself from the competition, and enhance your ability to communicate those differences. The Institute is a professional association, advanced education provider, and standards body for financial advisors, investment consultants, financial planners, and wealth managers who embrace excellence and ethics. Through our events, continuing education courses, and acclaimed certifications, which include the Certified Investment Management Analyst, Certified Private Wealth Advisor, and Retirement Management Advisor certifications, we deliver Ivy League and practical education for investment and wealth professionals. This episode is brought to you by Behavioral Finance Week. The Investments in Wealth Institute, in partnership with Charles Schwab Investment Management, have joined forces to bring greater awareness to the field of behavioral finance. I'm your host, Bob Powell, editor of the Institute's Retirement Management Journal and editor of the Street's Retirement Daily. Today, our topic is behavioral finance with our guest, Omar Aguilar, PhD. Omar is a senior vice president and chief investment officer of Charles Schwab Investment Management, a subsidiary of the Charles Schwab Corporation. So welcome to the podcast, Omar. Let's start by having you tell our listeners a little bit about yourself and why you're here, your name, your title, your position, your bio.
Yes, thank you very much for having me this morning. Very excited to be in this podcast. My name is Omar Aguilar. I am the Chief Investment Officer for Equities and Multi-asset Strategies for Charles Schwab Investment Management. I've been with Charles Schwab for over 8 years now, and I've been in this industry for more years than I actually get to accept. But, I've been around, probably since the early 90s, working on different asset management groups around Wall Street. And now we are very happy to be representing Charles Schwab and working on solutions for clients. My group is currently responsible for over $240 billion in assets. That ranges from equities and multi-asset solutions, where our goal is to deliver, clients what they need and trying to solve for what they're looking for by looking through their eyes. So that's a big part of our mission here. The reason why I'm here this morning is to talk about a very exciting part of our job, and my job in particular, and something that is very close to my heart and passionate for over 30 years in my life, which is talk about behavioral finance. It's talk about the impact of behavioral finance in advisors and their clients. And I really want to emphasize that this is something that is keen for everybody to build better relationships with their own clients. So I'm hoping that, after this podcast, that people get a little bit of a glimpse on how they can enhance their relationship with their clients.
Right. And as I mentioned at the outset of our podcast, the Investments in Wealth Institute, in partnership with Charles Schwab Investment Management, you've joined forces to bring together greater awareness to the field of behavioral finance. There'll be a conference in September about this. But for the benefit of our listeners who may not understand the difference between behavioral finance and perhaps behavioral economics, maybe a short little primer on what behavioral finance is and what it's about.
Yes, absolutely. Well, behavioral finance is a field. A technical definition is a subfield of behavioral economics. The idea of behavioral finance is trying to couple the traditional work on economics that has been around for ages with insights that we have gained over the years on behavioral science and human decision making. This is, the key part of this is understanding that we are all humans, that at the end, we all use our gut as well as our feelings to try to make investment decisions. And that's something that is new and relatively new because it's a, combination of, the world of statistics, mathematics, and economics with psychology. So the idea of behavioral finance is, this psychology-based theory that is trying to explain what the traditional mathematics, traditional economics cannot explain. So if you think about it, in many cases, there has been multiple examples through the years where people cannot really explain why the stock market behaves the way they behave. I can actually probably even explain what happened last week in the market or the last few years in the market, have very irrational explanations. So psychology is a way for people that try to use to explain what may not make sense in the traditional economics way. Individual behaviors and thoughts impact the way that people make their own decisions in their real life. Their spending, their investing, their trading, their financial planning, their portfolio management, and in many cases it's what they look into an advisor to for help. Because we are all wired differently, and because we all have very keen emotions and psychological biases, it is very easy for us to seek help. So the idea of behavioral finance is how to create that combination where there is a mathematics background of what you need to know, that is traditional economics, with the psychology part of it where you're trying to address what the client's needs might be.
So let me interrupt, Omar, for a second. When it comes to behavioral finance, you've noted that a good advisor has to apply the techniques that they've learned around the subject of behavioral finance to correct for those factors. Can you just talk a little bit about how they would go about doing that?
Yeah, I mean, a big component of this, as I was explaining, is marrying the traditional mathematical and statistical economics with psychology. So a good advisor is basically trying to become that link between, what the client's thoughts process is in terms of spending, investing, trading, financial planning, and at the same time the psychology, or what, how is they going to jump to those conclusions. So a good advisor is not necessarily giving them an answer, but is basically recognizing that there is a lot of factors that are going into making that final decision. It cannot just be all mathematics and being objective. It does have to marry with what the psychology is of the client to just make that right recommendation.
So, just for a moment, let's go back in history. Behavioral finance is not that old of a subject. I've had the luxury, the pleasure of talking to Richard Thaler shortly after he wrote his book about the history of behavioral finance. But I think you would do a much better job than me of describing how we got here.
You're right. It's it is sort of fairly new in the context of economics, but certainly it goes back to 1979 when Danny Kahneman and Amos Tversky introduced the concept of prospect theory. And the whole idea is, they realized that at the time that the capital markets, didn't have the power to explain everything that was going on around us. So the whole idea of prospect theory is that they realize that people don't necessarily put the same amount of weight in positive outcomes than on negative outcomes. The whole idea of prospect theory is the idea of framing the idea of risk and using that frame to figure out how people make decisions. So the whole idea of people looking at credit ratings, people looking at stock predictions, to take people at what the market assumes as being the default option for the future, is something that when they realize after the fact, they could explain a lot of the behavior of the capital markets, but not all of it. And not only that piece, it's just at the end of the day, they realize that the creation of bubbles, the creation of panics, the creation of different anomalies in the market were not as a result of traditional economics. The whole modern portfolio theory that we learned in the 1950s with Markowitz, all of a sudden were in question because there were a lot of things that couldn't be explained by traditional economics. So the whole idea of prospect theory, of understanding how people make decisions in adverse situations, is what drove the beginning of behavioral finance. And since then, the ability for things to evolve to where we are today.
And since then, the body of knowledge has grown, and it's come out of the shadows as as what might have been described as junk science, perhaps at one time, to a legitimate academic field.
Yeah, absolutely. And I think in many cases, the biggest accomplishment is obviously getting Nobel Prizes in economics, recognizing the fact that this field did have, in fact, a lot of scientific explanations that could lead into obviously understanding better what is our society about and what real economics is. Not everything is just one set of field like traditional economics.
Hmm. So we talked a little bit about where we've come from. Let's talk a little bit about where we are, and especially where we are with respect to the role that technology plays in behavioral finance. What does that intersection look like, that intersection of technology and behavioral finance?
Well, that's actually even more interesting and probably more relevant for advisors in this day and age. As I said before, the biggest part of behavioral finance is trying to explain and trying to recognize the fact that all of us are humans. And as such, humans have biases. And as such, we do have preferences. And I think that, as simple as it sounds, it creates the recognition that we could be our own biggest enemy. When it comes down to investment decisions, when it comes down to financial decisions, we tend to, extrapolate a lot of these, biases that are in us. I always give the explanation to our own clients here at Schwab that, it is very similar to sports. In many cases, when people have, a passion for sports and they root for certain teams, it is sometimes irrational to think that even when the odds are against your own team, you're still passionate and nervous, and you still have those feelings about what your team is about. And when they score or whenever they win, you celebrate without necessarily understanding why you're so happy. The same thing happens when it comes down to money. When it comes down to money and investments, those biases and those emotions get into the mix of how people make decisions. So, the advance of technology, in a way has created two things. One is it allows to channel those emotions in a way that provides a channel for people to make decisions that are more consistent with their views. But at the same time, it will also allow the advisors and the clients to prevent the typical mistakes that come when those emotions come about. So, in many cases, aligning the investors with their goals and objectives is what the role of technology is in this day and age. So, for example, there's programs that allows investors to save money for retirement on a regular basis. So we know that by having these default savings rates that gets introduced on a regular basis usually allows people to be more disciplined about investing for retirement. The whole concept of QDIA, target date funds, managed accounts, it's something that was created not too long ago to allow people to actually stay on track on areas that they need to have for retirement. There's also the idea of lower cost in terms of not necessarily following the market as it is. Having beta strategies and smart beta strategies that allow them to complement so that they can avoid the typical biases that are embedded in investing just in the market is another area that people have used to try to mitigate the traditional pitfalls of just following the market. And the most important program that has started in the last few years is the whole array of robo advisors. The whole idea of a robo advisors that allows to use behavioral based algorithms to try to optimize performance and try to give people the ability to just leave things in one place and stay out of it. And that's very interesting because the whole idea of a robo advisor where you have a program that automatically does everything for you, it is to try to prevent people for having to intervene at the wrong possible time.
Hmm. So you've written a paper called "Autocorrect: What Driverless Cars Can Teach Us About Behavioral Finance," and you say there's some similarities between what's going on in the world of self-driving vehicles and behavioral finance and the traps that we might fall into.
Yeah, absolutely. I found it fascinating in just trying to think how the evolution of the auto industry and the self-driverless cars, and it is with behavioral finance and the world of investing. And I certainly understand, and we can probably relate to what the debates have been at dinner table about what is the benefit of self-driving cars. I think if you think about it, the whole idea of the auto industry in creating these self-driving cars is because in the perfect scenario where all the cars are self-driving, the number of accidents will be low. because every single one of these cars will follow the same rules and will basically not have anything that will go out of the norm of whatever is dictated by the algorithm. So the whole idea of self-driving car assumes that there will be an ecosystem and there will be an infrastructure that will allow everybody to be in that circumstances. So the whole idea of capital markets efficiency, and that's sort of a big theory that Bill Sharpe started and created and had the Nobel Prize for, of capital market efficiency, is exactly the same dream world where every single car is self-driving and every single car follows the same rules, and at the end everybody sort of goes to where they need to be without having to worry about any accidents. Now, the reality, though, is that we are not in that situation. The reality is that there will be anomalies and there will be inconsistencies as long as there's a human behind the wheel or behind the design of the algorithm. So a lot of what we did in this paper was to try to recognize the fact that, also humans, tend to be the worst possible backup plans for the machines. That's sort of at the bulk of this paper. The bulk of this paper is that the self-driving algorithms, what is called, level 2, needed to have a default in case something goes wrong. So if something started to go wrong and things didn't go as expected, immediately the default will be to giving it to a human and provide the entire power or the control of the car now to a human. Now, the most interesting part of that research is shows that humans become the worst possible backup plans because we are not very good at reacting when things are in emergency. We're very good when things are going well, but in the case of emergencies or in the case of things that are going out of the ordinary or unexpected, we tend to overreact, underreact, or make the wrong decision. So now the process has become to figure out how you combine humans with machines to go what it's called level 4, which is not necessarily default to a human in the case of an emergency, but a combination of the car and the algorithm with the human as being the default option. So a lot of these similarities goes when it comes to investments and when it comes down to finance. And that is the key part of why advisors are key in this equation. In many cases, the robo advisors will provide a great setup. And in case of things don't go as expected, that's where the advisors can play a big role in working with the client to figure out what is the best alternative or what the robo advisors didn't get right or what the market didn't get right, and make sure that the client is consistent with their goals.
So much like we can't depend at the moment on the algorithms that drive self-driving cars, we shouldn't completely rely on the algorithms that are driving robo-advisors too. Is that fair to say?
And I think that's certainly the case. I would actually say that the benefit of robo-advisors is that they were designed similar to the self-driving cars by a human. In other words, these are not machines creating their own machines. This is obviously there's humans that are designing these algorithms, but they're not perfect. It's impossible to think that the robo-advisors will actually know exactly how markets will behave and what decisions to be made. And the most important piece, which is the reason why we will never rely 100% of these robo-advisors, is that every single client is different. And when you ask and you put the same scenario to the same type of clients, they will probably make different decisions because we're wired differently. And I think that's the key part of it. If you actually think about, I always give the example of going to the airport. When people need to go to take a flight, well, the destination is the same, the goal is the same, most likely the airport is going to be the same. However, people take different risks and try to get to the airport. There are some people like me that usually try to rush it and try to get through the gates and try to get to security as fast as we can to try to maximize the possible time. Whereas there's other people that for the same goal would like to be there 2 hours in advance. And, they always make their flight and they're always that. I like to take a little bit more risk. But that's what makes us different. So the robo-advisors, while we can train them, what we can actually give them a lot of our preferences, it will be very hard for them to know how people will react on any given circumstances. And that's the key part of where the advisor's role becomes.
Is there anything else about the autonomous vehicle field that might provide some helpful context around this?
Well, I think the learnings about what we've seen in these self-driving and the auto industry, had to do what I called, the potential solutions for advisors, which is in finance portfolio construction. If you think about it, the great reason why robo advisor success is clearly to provide scale, to try to identify and make sure that advisors are doing what they're supposed to be doing, which is servicing their clients. Having to go in and out of the market every single day is probably something that may not necessarily be what they want to do, because at the end of the day, their job is to be able to maintain and foster long-term relationship with their clients. So when we think about this piece and what that does is, the self-driving car algorithm is something where you're investing a significant amount of research to try to create as much scale and efficiency as you can, with the understanding that there will be an advisor that will be driving the majority of the time in translating what the client wants to have and what the robo advisor wants to have. And I think this is the key part of what I would like for this podcast to actually be part of it. At the end of the day, whether it's in the auto industry or in finance, we have to reconcile what is what client wants and what the client needs. I think that component of the trade-off between what the client wants and what the client needs is a big component of what I think makes behavioral finance so rich. And the answer to that is portfolio construction. Just if you think about in the auto industry, again, the self-driving cars algorithm have very clear components, whereas in the case of behavioral finance and in particular investments, the robo advisor has that algorithm. So it's a big component of how these all work together. That is an evolution that is sort of exciting.
So, Omar, given that most investors can be their own worst enemies in a market crash, how might we design a system that fully accounts for the necessary complexity without relying on the weakest link as the fallback?
Well, I think that's a great question, Bob. I think the test of any systems or any technologies or programs or algorithms is usually when things don't go as planned. And I think the answer is clearly part of our classic, finance situation, which is something where you need to go back to the original idea of classical finance of building portfolios. But when we think about, the way that it was originally designed by Markowitz in the 50s, it is not just create a utility function and try to optimize and create an asset allocation. What this tells us now, given that everything has evolved so quickly and we have a better understanding of how people make decisions, is really to create a portfolio construction process. So I think the difference between just a portfolio and a portfolio construction process is the understanding that there is a behavioral finance exercise behind that word process.
So what are your suggestions then for dealing with portfolio construction as a process?
Well, that's a big component of what I think the new frontier of investing has become. The number one thing is accept that the market is not efficient. Accept that not everything is going to be perfect. Just like we were talking about the automotive industry, there was always going to be things that are not going to work as expected. Therefore, we will always need to find innovative ways to adapt and prepare for those unexpected circumstances. Number two, portfolio construction, and this is probably the key part of the podcast, it's a balancing act of what the clients want and what the clients need. If you think about the client's needs, in many cases, it is really just a solution that comes from the traditional book of finance. This is traditional. You can put it in your software, financial planning. It will come out with an algorithm that tells you what the client might need based on those very objective inputs. However, the role of portfolio construction is balancing that out with what you as an advisor know that the client actually wants. So what the client wants may be at odds with what they need. In many cases, that balancing part is what a true portfolio construction process is about. We have to realize that utility functions differ from investor to investor. They also change over time, and they have multiple dimensions. Risk is not necessarily volatility. And I think those are the traditional issues that we have to deal with when we talk about portfolio construction. Risk is usually seen as, oh, volatility in the market is going up and down, but risk is just really a function of what the client understands being their own risk. And as I said before, it goes back to a utility function that is not necessarily just the typical risk assessment that most traditional softwares will provide. And I would probably say the most important part of this thing is understanding that there will be an implementation approach. So portfolio construction process is not just about creating a strategy, it also creates an implementation approach that allows you to execute on that investment strategy. So what I would probably say is it goes into three particular steps. Number one, understand what the client wants and meet what the client needs. Number two, understand what is the risk in the definition that the client wants you to understand the risk is. And what we call here at Schwab is sleeping well at night. What will make the client sleeping well at night? That's the second part. It's so critical to the portfolio construction process. And the last step is how are you going to create a systematic and disciplined approach to implement those outputs that you get from the process. So it is a three-step process that is something that advisors can easily relate to.
Can you also touch on this notion of how rebalancing may be the easiest part of portfolio construction, at least to automate, but how it may also serve as an additional trigger for behavioral biases?
Well, it is probably the most typical of those behavioral biases. Usually, the rebalancing algorithms that you embed, or even the agreements that you get with the clients, usually get triggered in types of situations where the things are not going as expected. And I think the biggest part of these is going back to another dimension that we have studied here at Schwab that is related to demographics. So investors, react differently, even if they're the same age, even if they're raised by the same family, even if they have the same level of wealth. Still, the utility function is unique to each one of the investors. Now, when you start mixing different experiences in the market, then the interactions become even more. So the rebalancing the algorithms usually happen in a very systematic way under normal circumstances. Most rebalancing mechanisms and algorithms tend to work really well. It is really in those periods of excess risk, or when things go beyond what is expected, that these rebalancing algorithms tend to trigger the emotions. And I would probably say there's big differences depending on whether or not you're a baby boomer, whether you're a millennial, whether you're a Generation X, because of their experience of what they have seen. So for example, baby boomers, they tend to be overconfident. They tend to have a significant and very strong, what is called in behavioral finance, confirmation bias. They tend to believe they're invincible, and they're highly competitive. What that means is they like the market, they like to grow, they tend to be more patient when it comes down to selling their losers, they tend to look for the best next possible opportunity to invest. So in that particular case, when you have these rebalancing triggers, they may be at odds of what they're thinking, and they have probably more tolerance to risk that what you as an advisor would like to provide to these baby boomers, because they trust you and they trust the market. And that's a big part of what baby boomers, traits are. When you come to millennials, usually millennials tend to be, in a way, even for their younger age, opposite to what it was to baby boomers. Because of their experience in the market, you just have to think that by the time they were in high school, we had at least two market crashes. And by the time they finished college, they probably were in the worst possible financial crisis we have seen in history. Therefore, they have a lot of skepticism towards equities and towards investing in the equity market. They don't trust the market. However, they're very social. They try to listen to their peers. They have this, what is called herding instincts. They tend to have long investment horizons. And what is the traditional risk spectrum, and this is the key part of differentiating thing, risk for millennials is a very different definition what it is for other generations. Millennials are happy to invest a significant amount of money in Bitcoin. they're happy to invest in areas that have to do with ESG when they're willing to just go for that particular mission, regardless of what is traditional risk. However, when it comes down to saving for retirement, they want to have everything in cash. So the interesting part about the components of millennials is just the psychology of what drives them to decision making that makes behavioral finance even more relevant for advisors.
So it sounds like the degree to which an advisor can incorporate these behavioral aspects into portfolio construction could go a long way toward them building strong and long-lasting relationships. So what advice might you have for advisors in terms of how they can mitigate their clients' behavioral impulses and biases?
Well, I think the first thing is realizing that most clients are not aware consciously about their own biases. You may actually have a conversation with a client where you try to probe and you try to ask about their biases, and you may get answers, but sometimes they're not necessarily in sync to what the real biases are. So understanding the client goes back to understanding what they really want, and try to get to that component is a critical path. Now, it is also a dynamic process, which again makes it even more relevant for advisor. What that means is that these preferences, these biases change over time. Usually, especially what is called cognitive biases, they tend to be driven by data. You can actually, people can convince themselves about certain biases that they want to have and what they want to do. So a big role of the advisor is understanding what kind of client do they have. Is this somebody that is emotional driven or is more cognitive driven? And that part of understanding, it's something that you have to work directly with your client. Knowing your clients better, it is a key component of having better long-term relationship with their clients. And you have to learn from them. Overall, even if you have to work with them and being strict about it, you basically create an implementation algorithm, a rebalancing algorithm. And whenever you get that phone call, when the market is off 800 points, you are actually going to say, we talk about this. We know what we're going to do. We have seen this before. And sometimes that conversation is what really drives people to stay put with their own investment strategy. Stay with their goals and make sure that you understand the trade-off between what they want and what they need.
So you I think have talked in the past about creating standing touch points. Any examples of those?
Well, it's an interesting mechanism, and it's going back to the demographics component that I discussed before. Communication is key for relationships. When it comes down to clients, understanding what drives your client decision making and their anxieties, usually goes a long way to improve those touching points. So, for example, a baby boomer usually have a significant amount of trust in their advisor. What they want is to basically for you to have them in their office or talk to them and give them a phone call to make sure that you continue to confirm what the strategy is and try to get their input and try to provide recommendations so that they feel that their strategy is going according to what you two together, put in place. Millennials on the other side, what you actually end up happening is you have to provide a significant amount of data. They tend to be very social in nature. They tend to understand and trust the advisors, but they probably in many cases have to check the data. So that component of providing data, providing feedback, anticipating what their questions might be, goes a long way in getting the millennials consistently going through their strategy. Their level of patience for millennials to stay put with one strategy is something that you have to reinforce on an ongoing basis, given the nature and given the social nature of what they have. Now, I haven't talked about Generation X, which, by the way, is my generation. And the reason why is that most of the studies out there have always been about baby boomers and millennials. And I always joke about the fact that with Generation X, half of the Generation X behaves like baby boomers, and the other half pretend to be millennials. So in a way, you actually have to figure out how to blend the two to come up with what is the best way to address Generation X.
That's fair. So what do you see for the road ahead with respect to behavioral finance? What's on the horizon?
Well, just think about just the same way that we talk about the auto industry. I think the sky is the limit when it thinks about technology. I don't think that we will ever get to a point where we'll all be in a self-driving cars. The same way that I don't think robo advisors will ever take the role of the actual financial advisor. We're still people, we're still humans, and we're still going to need help. However, because the information flow is going so fast, because there is a lot of data that needs to be processed, marrying the computing power and the data science with what the psychology is on understanding the behavioral needs of a client is something that will just continue to grow. Classical models will have to evolve. Understand that the behavioral insights that you can get from your client will basically get you long-term relationship, not just with that client, but potentially to build more business opportunities. Because it's not just about giving somebody a portfolio. It is about giving somebody a solution that addresses their needs, but at the same time that addresses what they really want and adapts to what their utility function is. And I think understanding that uniqueness of each one of those relationships is what it will continue to gain market share, and it will continue to make practices for advisors more robust and better relationships in the future.
And for the advisor, this is an opportunity to differentiate themselves in ways, instead of fearing robo advice, if they incorporate it and then add to it the behavioral finance expertise, they can really separate themselves from other advisors, I would guess.
Absolutely. I think the more you understand that robo advisors are here to help, but they're just one part of the process. And I keep on emphasizing the word process. Robo advisors are just giving you one part of the process, but it will never take over your relationship.
Anything that we haven't touched on that you think our listeners would be helpful to hear from you on before we wrap up?
Well, no, it's been great. Thank you, Bob, for all the questions. I think the area of behavioral finance, especially comes down to individual investing and serving clients, is an area that I think people are starting to grasp on, and especially now with everything that is going on in the world, and the more information we have, the better it is for advisors to differentiate themselves in using more insights into what the clients actually want.
Well, thank you, Omar, for being a guest on the Exceptional Advisor podcast. With hope you'll come back on in the future after you publish another paper or you speak at another conference, or just come back on when you have something to add and say to our listeners.
It was a pleasure. Thank you, Bob. Happy to be back anytime.
Thank you, Omar. Thank you for listening to our Exceptional Advisor podcast. If you've enjoyed this podcast, please subscribe through iTunes, Spotify, or on our website at www.investmentsandwealth.org/podcast to get the latest episodes of our Exceptional Advisor podcast series. The Investments and Wealth Institute has been helping investment and wealth professionals become exceptional advisors for over 30 years. Please visit us at our website, investmentsandwealth.org, to learn more about our certifications, conferences, online learning, and continuing education programs.